world is watching a war. They are analyzing troop movements. They are debating the ethics of intervention. They are listening to speeches about restoring democracy. They are missing the point. What you are witnessing is not a political liberation. It is a foreclosure. It is the final kinetic phase of the largest hostile takeover in corporate history. We are not looking at a country. We are looking at a distressed asset with a book value of $17 trillion. For the last decade, this asset was artificially suppressed. It was starved of capital. It was legally encumbered. It was driven into insolvency. And now, under new management, it is being liquidated. This is the forensic blueprint of how you buy a sovereign nation for pennies on the dollar. To understand the magnitude of this transaction, you must first ignore the rhetoric and audit the geological balance sheet. Venezuela possesses the largest certified oil reserves on the planet. 303 billion barrels. That is more than Saudi Arabia. It is more than Iran. It is more than the United States and Canada combined. But the strategic value here is not just quantity. It is chemistry. The United States shale revolution produced an ocean of light, sweet crude, but the massive refineries of the U.S. Gulf Coast, the industrial heart of the global energy system, were not built for light oil. They were engineered to process heavy, sour crude. They need a specific type of hydrocarbon sludge to run their cokers and maximize their profit margins. Venezuela is the world's premier reservoir of this specific grade. Without it, the U.S. refining complex is structurally unbalanced. So, how do you acquire a $17 trillion monopoly? You don't make an offer. You crash the valuation. The operation we just witnessed was a sovereign leveraged buyout. In the private equity world, an LBO works by loading a company with debt, squeezing its cash flow, and forcing a sale. The U.S. government applied this exact mechanism to the state of Venezuela. It began with the valuation gap. Under the previous administration, the risk premium on Venezuelan assets was infinite. International oil companies could not book the reserves. Creditors could not seize them. The state could not sell them. By January 2026, production had collapsed to 900,000 barrels per day. In the eyes of Western financial markets, the enterprise value of PDVSA, the state oil company, was effectively zero. This was not an accident. It was a manufactured liquidity crisis. Through a systematic campaign of maximum pressure, the revenue arteries of the state were severed. The sanctions regime functioned as a, quote, poison pill. It prevented the country from refinancing its debt. It blocked the import of diluents, the chemical solvents required to make their heavy oil flow. It forced the trade into the shadows, where oil was sold at a 40% discount to ghost tankers. The result was a distressed asset trading at a historic discount. The intervention by U.S. forces was the de-risking event. By removing the political leadership, the risk premium evaporates. The reserves move from stranded assets to recoverable assets overnight. The $17 trillion in value that was locked underground is instantly repriced onto the balance sheets of the victors. But to truly understand who wins, you have to follow the mechanism of the debt trap. Because before the first Marine landed, the legal trap had already snapped shut on Venezuela's crown jewel. If the oil fields are the long-term prize, CITGO Petroleum is the immediate cash-out. Most Americans know CITGO as a gas station on the corner. But in the energy underworld, CITGO is a strategic fortress. It owns 3 massive refineries in Louisiana, Texas, and Illinois, with a combined capacity of over 800,000 barrels per day. It controls a network of pipelines and terminals that are critical to the U.S. interior. For decades, this was Venezuela's downstream insurance policy. It allowed them to refine their own heavy crude within the United States and capture the profit margins at the pump. But in November 2025, a federal court in Delaware approved the sale of CITGO's parent company to a new entity, Amber Energy. Who is Amber Energy? It is a shell company. The real hand moving the pieces is Elliott Investment Management, led by Paul Singer. In the distressed debt markets, Singer is not an investor, he is the apex predator. This is the man who famously seized an Argentine naval frigate in Ghana to force a sovereign debt payment. When Elliott Management appears on the cap table, you are not looking at a restructuring. You are looking at a carcass being stripped. The acquisition of CITGO was structured as the sale of the century. The winning bid was $5.9 billion, but independent analysts pegged the replacement cost and cash flow value of CITGO between $11 and $13 billion. The Venezuelan state valuation was $18 billion. Do the math. Elliott is acquiring a strategic U.S. refining complex for roughly 50 cents on the dollar. How was this legally possible? How do you seize the assets of a sovereign nation to pay private debts? It required a legal breakthrough known as the alter ego theory. Under the Foreign Sovereign Immunities Act, a country's assets are usually untouchable. But creditors argued that the Maduro regime had erased the line between the government and the oil company. They argued that PDVSA was merely the alter ego of the state. A U.S. court agreed. This ruling pierced the corporate veil. It turned CITGO from a protected subsidiary into a liquidation pool for every corporation that Venezuela had ever wronged. But there was a poison pill buried in the structure. Back in 2016, desperate for cash, PDVSA issued the 2020 bonds. To get investors to buy them, they put up 50.1% of CITGO's shares as collateral. When sanctions hit in 2019, Venezuela defaulted. Technically, the bondholders, funds like Ashmore and BlackRock, should have seized the company then. But the U.S. Treasury stepped in. They issued General License 5A, which suspended the foreclosure. Why? Because if the bondholders seized it, the asset would be fractured. The U.S. government kept the asset frozen in a state of suspended animation until a, quote, preferred buyer could be arranged. That buyer is Elliott. To clear the title, Amber Energy agreed to a $2.1 billion settlement to pay off those bondholders. This was the fee to unlock the handcuffs. With that lien removed, the path was clear for a total transfer of ownership. So where does the $5.9 billion go? Does it go to the Venezuelan people to buy food and medicine? No. The Delaware court established a strict creditor hierarchy known as the queue. The proceeds are distributed in a, quote, a waterfall. The first drop of water goes to Crystalex, a Canadian mining company owed $1 billion. Next comes Tidewater, a marine services firm. Then comes the giant, ConocoPhillips. Conoco is holding an arbitration award of $8.7 billion. While they won't get all of it from this sale, they are positioned to absorb the majority of the remaining cash. The sale of Venezuela's most valuable foreign asset is a transfer of wealth from a Latin American state directly to the balance sheets of North American corporations. This is the mechanics of the sovereign leveraged buyout. You starve the target until it defaults. You use the default to trigger legal seizures. You depress the asset price through sanctions. And then you approve a sale to a domestic ally at a historic discount. But CITGO is just the appetizer. The real money isn't in the refineries. The real money, the kind that shifts global power balances, is hidden in the currency wars. Because while everyone was watching the auction block in Delaware, the U.S. military was securing something far more critical than oil. They were securing the survival of the U.S. dollar itself. To understand why the United States effectively foreclosed on a sovereign nation, you have to look past the oil barrels and look at the currency they are priced in. For 50 years, the global economy has run on a single, non-negotiable operating system, the petrodollar. The deal is simple. The world buys oil. You must pay for that oil in U.S. dollars. This forces every central bank on earth to hoard dollars, creating an artificial, permanent demand for American currency. It is the infinite liquidity engine that allows the U.S. government to print trillions of dollars in debt without collapsing its own economy. Venezuela tried to break the operating system. Under the previous regime, Caracas began pricing its oil in Chinese yuan. They launched a state-backed cryptocurrency, the Petro, specifically designed to bypass the U.S. banking sector. They were negotiating direct energy for goods swaps with Russia and Iran. In the eyes of the Federal Reserve and the U.S. Treasury, this was not just economic policy. It was an act of war. It was a crack in the foundation of the dollar's global hegemony. If one major oil producer successfully exits the dollar system, others follow. If Saudi Arabia follows, the demand for the dollar evaporates. The value of the currency in your pocket collapses. The U.S. debt market implodes. The intervention in Venezuela was a system maintenance operation. Notice what happened the moment the dust settled. The Petro was dissolved. The yuan contracts were voided. The new administration immediately announced that all future export revenues would be denominated exclusively in U.S. dollars, deposited into escrow accounts controlled by the Federal Reserve Bank of New York. This is the money trail. And if you follow it, you realize that Venezuela is no longer a country. It is a colony of the U.S. financial system. The revenue from those 300 billion barrels of oil does not go to the Venezuelan treasury. It flows directly into protected accounts in the United States. This is the lockbox mechanism. Here is how it works. The oil is extracted by American contractors like Chevron and Halliburton, who have now returned to the Orinoco Belt. They sell the oil on the open market. The cash from that sale hits a U.S. bank. Before a single cent is released to Venezuela for humanitarian aid or infrastructure, the waterfall begins. First, the U.S. oil majors deduct their operating costs and their profits. Second, the debt service payments are stripped out and wired to the bondholders, the hedge funds and investment banks we discussed earlier. Third, a reconstruction fee is withheld to pay for the military and logistical costs of the intervention itself. Venezuela is paying for its own occupation. This is the ultimate evolution of neocolonialism. You don't need to plant a flag. You don't need a colonial governor. You just need to control the SWIFT code and the escrow account. The country retains its name, its flag, and its national anthem. But its GDP is effectively a line item on the U.S. Treasury's balance sheet. But the consequences of this go far beyond South America. This operation sent a terrifying signal to the rest of the global South. It demonstrated that sovereignty is a conditional status. If you are a nation like Nigeria or Iraq, or even a BRICS member like Brazil, you are looking at Venezuela and doing the math. You realize that if you hold your reserves in U.S. dollars, or if you integrate too deeply with the Western banking system, your national wealth can be frozen, seized, and liquidated the moment you deviate from the script. This creates a paradox. The U.S. secured the oil, and they secured the immediate safety of the dollar. But in doing so, they have accelerated the world's desire to escape the dollar entirely. They have proven that the U.S. financial system is weaponized. And this brings the danger home to you, because the mechanics used to strip Venezuela of its assets, the freezing of accounts, the reclassification of property, the alter ego legal theories, these are not just tools for foreign policy. These are financial weapons that have been tested in the field, and now they are coming back to the domestic market. We are witnessing the normalization of seizure. If the government can redefine the ownership rights of a sovereign state to satisfy a debt crisis, what makes you think private property rights are safe during a domestic financial collapse? The architecture of control is complete. The oil is secured. The currency is defended. The creditors are paid. But the final phase of this operation isn't about what happens in Venezuela. It's about what this new abundance of cheap, stolen energy means for the future of the American empire, and specifically for the artificial boom that is about to hit the U.S. stock market. They didn't just buy a country, they bought a timeline. And you are about to live through the most volatile economic expansion in history. The injection of 300 billion barrels of cheap American-controlled crude is the defibrillator shock the U.S. economy has been waiting for. And this is where the timeline splits. For the average consumer, the immediate future looks like relief. You will see gas prices collapse. You will see the cost of transport drop. The inflation monster that has plagued the Western world for the last 4 years will appear to be slain. The Federal Reserve will declare victory. They will look at the falling energy CPI and use it as the justification to slash interest rates aggressively. This is the trap. The Venezuela stimulus creates an artificial window of prosperity. Lower energy costs plus lower interest rates equals a market melt-up. We are about to witness a parabolic move in the S&P 500. This is not organic growth. This is the final looting phase. The smart money, the same institutions that bought CITGO for pennies and financed the debt restructuring, know that this stability is a mirage. They know that by seizing Venezuela, the U.S. has crossed a red line that accelerates the end of the unipolar world. China and Russia are not watching this idly. They are already accelerating their move into gold and hard assets, preparing for a world where dollar assets can be deleted with a keystroke. But in the short term, the market will roar. And this is designed to draw you in. The retail investor will see the green candles. They will see the mission accomplished banners. They will deploy their savings into the top of the most manipulated bubble in history. And while you are buying, the cartel will be selling. They will use this liquidity event, funded by stolen oil, to exit their positions and move into tangible assets. Farmland, precious metals, defense contracts. The foreclosure of Venezuela was not just about securing oil. It was about manufacturing one last great bull run to allow the architects of this system to cash out before the structure collapses. You are watching the controlled demolition of the old energy order, disguised as a liberation. This leaves us with the uncomfortable reality of how empires survive. We are taught that stability is the natural state of things, but history shows us that stability is often purchased with the sovereignty of others. So here is the question you need to answer in the comments. Was the liquidation of Venezuela a necessary act of system maintenance to protect the global economy and your currency? Or was it simply the largest armed robbery in human history? Drop your verdict below. If you want to understand the mechanics of power before they are applied to you, you need to be in this room. Click the subscribe button. Turn on notifications. We don't deal in news, we deal in leverage. You are either at the table or you are on the menu. Your briefing continues here. The mechanism we just exposed is only one gear in the machine. Click the video on your screen to access the next level of intelligence. It is the missing piece you need to complete the picture. I'll see you there.